A major bank has published a scenario for silver with a price target of $309. We need to analyze how they arrived at that number. This isn't about speculation, it's about understanding the model. The forecast is the logical conclusion of several powerful economic forces converging now. In this analysis, we will break down the data, the historical precedents, and the structural economic changes that make this scenario a possibility. We are examining the mechanics of a potential repricing event. The model, the $309 figure, originates from an analysis by Michael Widmer at Bank of America. It is not a base case prediction. It is a mathematical model based on the historical relationship between gold and silver, known as the gold-to-silver ratio. The analysis presents two key historical scenarios. The first applies the ratio seen in 2011 when silver last peaked, which would place silver at $135 per ounce. But the second scenario uses the extreme ratio seen during the Hunt Brothers market corner in 1980. If the gold-to-silver ratio were to compress to that same level again, with gold trading at projected future prices, the mathematical result for silver is $309 per ounce. Now, Widmer himself is careful. He notes that the price could cap at $309, acknowledging it as the peak of a potential rally rather than a guaranteed average trading price. But the very fact that a Tier 1 financial institution is publishing this scenario is a significant event. It forces us to ask a serious question. What conditions would need to exist for such a compression to happen? As it turns out, those conditions are not just emerging, they are already here. The supply deficit. The primary driver for a silver repricing is a structural supply deficit. The silver market is projected to be in a structural supply deficit for the sixth consecutive year in 2026. Think about that. 6 straight years where industries, investors, and jewelers have used up more silver than all the mines on Earth. That extra silver comes from above-ground stockpiles, but those inventories are not infinite. The cumulative deficit is estimated to be approaching 900 million ounces, more than an entire year of global production. Once that silver is used, it's gone. This isn't a temporary blip, it's a chronic, worsening condition. About 70% of silver is produced as a byproduct of mining other metals like copper, lead, and zinc. This creates a severe supply inelasticity. Production can't easily scale up to meet surging demand. A structural flaw that virtually guarantees continued deficits as demand accelerates. If you find this analysis valuable, join us here at Paradoxical Pathways as we navigate these complex shifts. Subscribe and hit the bell to stay ahead. Now, let's look at why demand is about to explode. Industrial demand. This is what truly separates silver from gold. While gold is primarily a monetary asset, silver is a critical, consumed industrial commodity. Industrial applications account for the majority of all silver usage, approaching 60% of total demand. Let's start with the green energy revolution. Solar panels are a voracious consumer of silver. Every photovoltaic cell uses silver paste to conduct electricity. This demand has become relentless. Next, consider the electric vehicle. A battery electric vehicle requires significantly more silver than an internal combustion car. Between 25 and 50 grams of silver are required per vehicle. And now a new giant has entered the room. Artificial intelligence. The AI revolution runs on data centers. Data centers filled with high-performance servers and semiconductors rely on silver for its conductivity. The most important part to understand is that this industrial demand is almost completely price inelastic. A company building a billion-dollar semiconductor plant will not halt production because the price of silver rises. The amount of silver is small relative to the total cost, but its function is absolutely critical. There is no viable substitute. They must secure the supply, whatever the cost. Historical precedent. This measures how many ounces of silver it takes to buy 1 ounce of gold. For centuries, the long-term average has hovered somewhere between 60 to 1 and 70 to 1. However, the ratio rarely stays at its average for long. It swings to wild extremes. When the ratio is high, it signals that silver is historically cheap compared to gold. History shows a repeating pattern. After the ratio spikes, it inevitably reverts or compresses. During this compression, silver doesn't just rise, it dramatically outperforms gold. We saw this after the 2008 financial crisis when silver surged to nearly $50 an ounce by 2011. We saw it again after the COVID panic in 2020 when the ratio hit an all-time high of 125 to 1. This is the engine behind Bank of America's $309 scenario. It's a what-if based on history. What if pressures force the ratio back to the 1980 extreme of 14 to 1? With gold at a new, higher plateau, the mathematics of that compression would demand silver north of $300. It's about a violent reversion to the mean and a historical reevaluation of silver. The monetary landscape. Governments are caught in a mathematical trap of debt. There is no easy way out. This no-way-out scenario leads many to believe a reset is inevitable. Investors flock to the only true monetary assets with no counterparty risk, gold and silver. An important development is countries beginning to buy silver for their strategic reserves. This is a monumental shift. For decades, the belief was that central banks only accumulate gold. It suggests a growing recognition of silver's dual role. It is not just an industrial metal, it is money. This is the ultimate accelerant. It combines supply pressure with the power of a flight to safety. To summarize the framework, the BOFA scenario models $309 based on historical compression and deficits. This is supported by a chronic supply deficit that is draining global inventories. Layered on top is inelastic industrial demand from the solar, EV, and AI revolutions. Historical precedent shows that when the gold-to-silver ratio reverts, silver's movement is often rapid. The ultimate catalyst is a global monetary system under strain, pushing investors back to hard assets. The question is no longer if silver will revalue, but to what magnitude. The $309 scenario is not a guarantee, but it is a logical, calculated outcome of these forces. Thank you for watching Paradoxical Pathways. Subscribe to stay informed on the financial shifts that matter. Make sure to turn on notifications for our next deep dive into the global markets. We'll see you then.